With me today is my colleague, Emily Patsy, and we're joined by Bill Marko, the Managing Director for Jefferies. Thank you very much for joining us and for giving your time to Hart Energy over the years, really, Bill. Let's start out by looking at your view of what's taken place in the past several weeks.
Well, thank you. It's my pleasure to be here. I really appreciate the opportunity. I've really enjoyed a 10 or 15-year relationship with Hart's. You guys have the best book in the business. And we've always had a great relationship with you, and you always put out quality information. It's been an interesting 2-3 months. I think that the way I think about this, and I personally felt the same way, like the first few weeks of the stay at home and the destruction in supply and demand was like a building collapsing. And, when say you implode a building and the building falls down, and all you see is smoke initially, and you're wondering, well, I wonder if it worked. We have to wait for the smoke to clear, and when it does, we'll see what it looks like. And that's kind of what the first month was like. We were waiting for the smoke to clear and see where were we going. We had more than 20 million barrel a day demand destruction. We had a few million barrel a day additional supply from Saudi and Russia to kind of exacerbate the situation. And so you had an imbalance of nearly 25 million barrels out of 100 million barrels of worldwide production. So, you saw some crazy things like negative price at the end of the May contracts. You saw companies initially, absolutely playing defense at first. They're all in really even survival mode, much less defense. What are we going to do about this? We need to cut capital. We need to cut dividends. We need to stop buybacks if we're doing buybacks. We need to think about G&A, and how deep we're going to cut capital. So I'd say in the first 4 to 6 weeks, you saw that begin. You've seen people subsequently cut capital a couple more times. Companies have cut from 20% to nearly 100% of their capital spend right now. And they're trying to kind of right the ship. Another analogy would be you're sailing and your ship is about to sink. And okay, now we got the ship rebalanced. Where the engines are running, we're going forward. Now let's see where we go. So it's caused a lot of confusion in the business. I've been doing this 40 years. I've never seen a downturn like this. I counted up the other day, it's my 9th downturn. And, no one's ever seen anything like this. So it's going to dramatically and permanently change the business.
And with that, Bill, what about specifically your overview of the state of the A&D markets? How are companies looking at it right now while really we're still waiting for demand to recover?
It's absolutely dead. The only activity you've seen on the A&D business has been deals that were underway and had agreements, and the sellers and buyers had to step back and look at current oil and gas price outlook and look at financing and kind of recast the deal. So you saw Shale in Appalachia, Devon and Barnett, and BP in Alaska redo the deals and then publicly announce the deals going forward. In every case, they lowered the upfront payments. The buyers did. And you had then triggers mostly based on price, where, hey, if price recovers, I can afford to pay what we originally agreed on. I can't afford to pay you up front what I said I was going to afford to pay you previously. In terms of new deal flow, it's dead. And it's because of the challenge of what will commodity price be in the next 3 months, in the next year, in the next 3 years. I mean, generally the buyers are attuned to commodity price of the day, strip of the day. But the sellers, of course, think about, I don't want to be a dummy and sell at $25 oil if oil is going to go to 50. I'm not saying it's going to go to 50 in any time soon. Nobody knows how much that's going to recover. The third leg of that is on the financing side. There's, the people with money. The public markets are shut completely. There's no way to raise money in the public markets at the moment. And then private capital is very conservative. Their investors are scratching their heads saying, where do we go? And the private equity sponsors are thinking, okay, where do we go? You had a couple of years ago, 3-4 years ago, $100 billion of private capital out there looking to invest. And now, we think it's maybe plus or minus $10 billion of real private capital out there looking to invest. Of course, they're thinking like everyone else, what's the right time and what's the right way to do so?
Thanks, Bill. And you mentioned earlier the cuts in CapEx, and E&P is going into survival mode. Could this environment result in a permanent lower capital spend with lower deal flow for the foreseeable future? Or do you see this possibly accelerating consolidation among E&Ps, maybe further down, not immediately, but further out in the year or possibly next year?
I'd say yes to all your questions. It's going to permanently change the business in the short to midterm. We're not going to see 100 million barrels a day worldwide demand in a long time. We're going to have some permanent destruction in demand, and then it'll have to build back up over time. I don't know where it will settle, at 90, 95 or something like that. For various reasons, you're going to see that. So it's going to change the nature of the business. Capital spending will be cut because, we're still in the mode that we got in 2.5 years ago, where the public investors told the public companies, you guys have lost us money for a long time. You got to start living out of cash flow. We're not going to invest in you until you're positive cash flow. And you had the business moving toward that. Probably a third of the companies were at positive cash flow. Maybe 20% were break even-ish, and the rest weren't there yet in terms of positive cash flow. You still have that mantra. You still have that that requirement by the public markets. So I think that means people are, with lower commodity price, people have less cash flow. They have less capability to spend capital, and so I think we'll see a permanent reduction in capital, at least through the midterm. I think in the longer term, it's possible we see, embedded demand in oil and gas production is higher than we think, and we're underspending in it. We're not replacing reserves in production. And then at some point we wake up and say, oh my goodness, we're short oil and gas. Now, everybody would love to see that. And that's not going to be in the next 6 months. It could be in the next few years, and it could be longer than that. So, and then the same thing with deal flow. You're going to see there's less capital available. There's no public markets for buyers to go to, and there's very little private markets for buyers to go to. So I think it'll be a slow awakening.
Well, let's move to U.S. Shale. It was previously a major driver of the bulk of A&D activity, but the U.S. Shale business has slowed down in recent years. Do you think the allure of U.S. Shale is gone? And if so, what opportunities remain in the upstream oil and gas sector?
No, I don't think it's gone. I think it, again, like everything, is going to change. You can think that certain basins work at certain pricing levels. Permian, of course, works at the lowest oil price level because it's the most attractive area. That won't change a lot, but it will change some. I mean, you've seen rig count get cut even 50% or more in the Permian. I think other areas will be even more challenged. Not a lot works at not much works at $35. Not a lot works at $45. So I think you'll see the money will go to where it's best invested. I think it'll mean a permanent reduction. We hit about 13 million barrels a day, I think, in the U.S., and we're probably going to go back to 10 or something million barrels a day. And again, we won't get back to 13 million anytime soon. So I think you'll see everything is going to shrink. Organizations are going to shrink. Capital is going to shrink. Deal flow is going to shrink. Rig count's going to shrink. We're down to 300, I think, in the Baker Hughes rig count. It was 800 a year ago, and it was 1,100 2 years ago, and it was 2,100 in 2014. So we've gone from 2,100, kind of at the end of the initial shale boom, to 300 today. It's going to devastate the service companies. It's going to, and all the E&P companies need to, cut staff, cut G&A. They need to cut G&A, so that's probably cutting staff as well.
You mentioned this earlier about the public equity markets being closed. In addition to that, debt issuance has also been largely bifurcated. So do you see this changing in the near future? Probably not, I think, but maybe next year or so. And what will it take for investors to return to oil and gas?
The investors are going to be cautious. There's a lot of headwinds in investor land. On the long term, you've got ESG concerns by investors, by people they raise money from, by family funds and others that think a lot about ESG. And oil and gas, is not that favorable for the people that are concerned about ESG. So that's kind of a long-term headwind. I think medium-term headwinds and short-term headwinds are, can you guys give me returns? I think there are people now thinking that, we're at the bottom. I'll shop at the bottom. And, now if oil goes from 30 to 50, I can make a lot of money. Still no one knows about, what the return will be. It's not going to be a V-shaped recovery. I think I call it like a fallen down check mark, the check mark, but then a really slow, elongated return where it fell really quickly, but it's going to come back very, very, very slowly. People call it a Nike swoosh. It's kind of a lane down Nike swoosh. I think that's what we'll see, and it's going to be over, many quarters, and which means probably a couple of years. So it's going to be cautious. It's going to be slow. The 100 billion of private money is 10 billion of private money. They're going to be really cautious. Right now, we've got a lot of noise in the business because you've got 25 or so small to mid cap companies that are publics that are trading less than $1. So they're all in trouble. Some have already declared bankruptcy, in restructuring. Others are going to follow. And I think that's going to work itself out in the next, 12 to 24 months. And then on top of that, people are thinking about, okay, if I move up in quality into the, the mid and large caps, what's interesting out there. But the people that could play offense, like the majors or others that are well capitalized, they're also having to just live through cash flow, balancing cash flow with capital with dividend payment. What's interesting, Exxon and Chevron decided to keep paying the dividends, even though they're going to have to borrow money to do it. And Shell and Equinor, on the other hand, decided not to continue paying the dividends at the same rate. They cut them by 2/3. And so everybody's addressing this differently. But, I think the bottom line is permanent change in the size of the business, the shape of the business, and investors are getting pickier and pickier. And, you got to show me that this works before I invest, where in the initial shale days, it was driven a lot more on, hey, I don't want to miss the boat. I think this will work. Let me come in early.
So expanding on that, Bill, are there differences in how private equity investors view U.S. oil and gas?
There are and there aren't. They're having some of the same problems that the publics are. These private equity sponsors, they go raise money from investors, and then the investors say, hey, put my money to work, find management teams and investments to put it into. I think in some ways, their portfolio-wise, they're having the same problems that the publics are in terms of, hey, I got 40 teams or I got 20 teams. A handful are doing good or decent, and many others may not be doing as well. What do I do about it? Do I need to consolidate? I think the public side certainly going to consolidate when I talked about restructurings. And I think we're seeing some of that come out on the private side where they're doing these smash goes where they push, 2 or more entities together that, the same sponsors, and they tell one team, hey, you're going to start running this other team's assets, and they tell the other team, hey, you guys are out. So, I think they don't have the quarterly kind of reporting where they have to, have more of a steady, steady quarterly results. They can do stuff, more lumpy or granularly, and they can do stuff more quietly because they don't have to report this. But I think they're looking, at where there are places to invest in the same way that other people are. And is it in midstream? Is it in these restructurings? Can I buy it 10 cents on the dollar? Can I get in the bonds and convert that into equity or trade it for assets or something like that? So they're thinking through a lot of the same things that the publics are.
And Bill, what's the path forward from here? We know oil and gas, the industry is a resilient one. You've mentioned going through, I think, 9 downturns and experiencing that. but we continue to see challenging times, things no one anticipated. What more can you say about the key to E&P survival, but also just company survival and moving forward?
Well, I think it's fundamentals matter. G&A per share or G&A per barrel matters. Low cost production matters. He who has the low cost production usually wins no matter what the commodity price is. Good rocks always matter. People in the better plays certainly are going to have better results. I think there's going to be less money available from the public investor side, from the private investor side. They're going to be pickier in how they invest. And, I think this will be where, the industry isn't going anywhere. We're still, even if we went, I think all electric cars around the world, we still need 75 million barrels a day instead of 100 million barrels a day. So, the industry still has to make jet fuel, still has to make, other products, still has to make petrochemicals, that sort of thing. But everything is going to shrink. And so everything is going to be harder and harder for companies to compete for funding and to compete for attention, and kind of mind share from investors. So I think people's stories need to get more specific. I think, like I said, the better rocks are going to win, which they should. And it's going to be a smaller business. I mean, U.S. rig count maybe 500 or 600, rather than the 1,100 or the 2,100 that it's been in the past. That might be a full rig count. So, there's just big changes coming. We were worried about, my age group, being 40 years in the business, is this big bubble that was moving through the business. And for a time, I think everybody's worried, because a lot of people got hired in the 70s and early 80s. And we were worried about, we're going to run out of all this great, smart talent because it's all moving through the business and there's not a lot behind it. I think now this kind of takes care of the shrinking business. Is going to say, well, guess what? It's not that big a problem before. We probably need these people to go home anyway. So it's, working itself out.
Thank you very much for your time, Bill. We appreciate it. I speak for Emily and I and Hart Energy, and we appreciate your time and all of your expertise as well.
Thank you, Jessica. Thank you, Emily. It's been my pleasure.
Thank you very much.
For more Hart Energy videos, follow our social media channels.